workforce housing is really the housing for the people who are the engines of our communities, the civil servants, the nurses, the doctors, the educators, the people that, live and work within the communities that they want to live. It's not necessarily the second and third homeowners, and it's not necessarily the government subsidized housing, but it's that missing middle, which has the greatest need, and it's the one that's most unsolved for. And that's really what we're looking to solve. If you think about it from a institutional standpoint, if you think about it from a banking standpoint, it usually ties to about somewhere between 100 and 140% of average median income is where the workforce housing market is kind of defined. And that's really where we spend a lot of our time, within that 100 to 140% of average median income.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsuranceRisk.com. Today, my guest is Lissette Calderon. Lissette is the founder and CEO of Neology Group, a vertically integrated, lifestyle-driven residential and commercial real estate firm that specializes in transforming undervalued neighborhoods into sought-after communities. And in just a minute, we're going to speak with Lissette Calderon about solving for housing's greatest need, a focus on workforce communities. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how attractive our guests are, please check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Lissette Calderon. Welcome to CREPN Radio.
Thank you for having me. It's a pleasure.
Well, I'm delighted to have you, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. Lissette Calderon, I'm the founder and CEO of Neology Group, as you said, vertically integrated lifestyle developer. We specialize in the workforce housing market. We've been around for about 21, 22 years now. And we really go into communities and think about reimagining and redeveloping them. And when we think about our business and our business model, we're really trying to prove that purpose and profitability aren't mutually exclusive. So we have business with a purpose. We think of our business as, just not return per square foot, but impact per square foot. And that's what we're doing. We've built about 1,500 condominium units, about 1,500 apartment for rent units. We're owner and operators of those units, and we've got about another 1,500 units in the pipeline right now, specifically in the South Florida market.
Oh, that's perfect. And that's exactly what we want to talk about today. The workforce housing or workforce housing communities. And so I guess the first question that comes to mind, when you say workforce housing, can you define it per what your parameters are as far as workforce housing and workforce communities?
Absolutely. Workforce housing is really the housing for the people who are the engines of our communities, the civil servants, the nurses, the doctors, the educators, the people that live and work within the communities that they want to live. It's not necessarily the second and third homeowners, and it's not necessarily the government subsidized housing, but it's that missing middle, which has the greatest need, and it's the one that's most unsolved for. And that's really what we're looking to solve. If you think about it from a institutional standpoint, if you think about it from a banking standpoint, it usually ties to about somewhere between 100 and 140% of average median income is where the workforce housing market is kind of defined. And that's really where we spend a lot of our time, within that 100 to 140% of average median income. So again, the people that are the engines and the drivers are communities, and the real heroes of what we're doing down here.
Got it. So in the community that you're in South Florida, when you are trying to change a community, what are some of the I guess the things that you look for, or you identify in order to jump in and begin?
Absolutely. And the fundamentals are the fundamentals. And it doesn't matter whether, you're in, the true affordable space, workforce space, or kind of the luxury space. The fundamentals still have to make sense. So even though you can go into some of these neighborhoods, the data still needs to support what we're doing. We've now really reimagined and reinvented, several neighborhoods. But the one constant in all our neighborhoods is that we go into neighborhoods where we're wanted, where there is a need. We think about authenticity and how we add to the culture and the vibrance of the community. We don't really try to go out and change the community, but rather we try to, elevate the communities and think about the communities differently. That said, there's certain things that we look for. First of all, as we said, we go into communities where we're wanted. We also look at the ability for public-private collaboration. So we want to make sure that the municipalities that we're going into support our work, support what we're doing, and they are true partners with us. So when we're thinking about streetscape lighting, when we're thinking about sidewalks, when we're thinking about traffic improvements, when we're thinking about parks and so forth, they really are working hand in hand with us to make sure that the communities are not just about our buildings, but it's about the entire neighborhood. So we always look for that. From a fundamental standpoint, because we really are for the engines that drive the communities, we're looking at employment. Where is the employment? Are we close to places of employment where people work, where people come in? In addition to that, is it close to services that people want to be? They just don't want to work. But are there restaurants in the evenings? Are there places that people can walk? Are there schools? We also think very importantly about transportation. How does the transportation fit into what we're doing? Is this a suburban commuter community, or is this an urban community that can work with public transportation? Is there a component of public transportation that's in there that we can leverage, that we really can think about in terms of workforce? And then we think about what is really kind of the catalyst. That is, what else is going on in that community? We obviously are the residential catalyst. We're usually the driver that reimagines and really redefines and reignites what these neighborhoods look like. But what else is going on? When we pioneered the Miami River, for example, there was a giant infrastructure improvement to the Miami River per se. It was being dredged, it was being cleaned. The city and the county were putting in river walks and so forth. So that was really important to us to work in that collaboration. And we felt between the partnership between ourselves and the collaboration that was going with the public sector, there was a real story to tell, and people really were going to come into this. More recently in Allapattah, where we just opened up our fourth tower in Allapattah, there, we realized that we were, at the heart of transportation. We were probably the last authentic neighborhood that hadn't really been reimagined. But more importantly, Allapattah lies within the health district. We happen to be the second largest health district after Houston. So we have this incredible place of employment, and there really wasn't the residential piece to it for people to be able to live and work close to their place of employment. Jackson Health, which is the largest public health institution, had passed an $800 million bond for capital improvements. More recently, they announced the largest emergency room in the nation, a $300 million project. So it's little catalysts like that we realize that really add to the neighborhood and the vibrancy. And when we work in collaboration with what else is going on in the neighborhood, we're able to solve for, really kind of this workforce housing shortage.
Got it. So if I understand right, are you the catalyst for the neighborhood change, or are you more like recognizing the public investment in a neighborhood and their efforts to improve a neighborhood, and then you guys come in and support that with housing?
I think it's done in unison. We definitely are the residential catalyst.
Okay.
We usually prove that there's a market. Oftentimes when we come in, the healthcare has been, the health district has been around forever. The Miami River was around forever, but it really took us, kind of shifting the paradigm and thinking about it different, that if we build it, they will come. But again, it's done, very strategically, very thoughtfully, very intentional in terms of, the product that we put in there. So we really go ahead and put these residential buildings and these residential neighborhoods on the map, and we become places where people not just want to work, but where they want to live. Usually by, before we arrive, oftentimes the housing product doesn't meet the need and the demand and what people would want. I always say I invite anybody to take any one of our projects and look at them and dissect them. And they are luxury projects. They, meet every aspirational lifestyle demand driver that is there. People want, and that is why we've had just incredible success in all our lease ups. Most recently, we opened up a building in end of February, beginning of March, 237 units. And today we are, about 80% leased and occupied. So in very short amount of time, we're able to lease and occupy our buildings. And it's because, we're really the best value proposition for our residents. The lifestyle that, we afford them is unlike anything else in the market. It's not just about the product. And of course, our product is exceptional. But it's also about the lifestyle that we afford them. And we do that through a myriad of facts. I mean, obviously, we curate our amenities, very intentional. We think about our amenities and what is it that our residents need. And then we think about the client experience and what does our client want to experience. So we make sure that they have, exceptional customer service. We have in-house management and leasing. So we have 24-hour support for them. So when you live in one of our communities, it's very clear that you're in a Neology community.
Got it. So the projects that you've been involved in, are these all new construction to you?
For the most part, most of them are ground up. That's not to say that we have taken on value add projects. We do have in our portfolio some value add projects, and that is when we buy the existing asset and really, again, the same way we reimagine the neighborhood, we reimagine the asset. We come in with significant capital expenditure dollars, both internally within the units and within the amenities. And of course, we add our management component and our lifestyle component to it. So we bring in those efficiencies and are able to create that product. And then, most about 75% of our portfolio is ground up development.
Got it. And as far as the properties that you are focused on, is there a unit count kind of a range that you
Yeah,
focus
we
on?
really don't focus on anything less than 200 units, just because of the time that it takes, both from a development standpoint, the manpower and women power that it takes to get these projects off the ground. It's the same whether it's 20 units or 200 or 300 units. And then just from an operational standpoint, our managers and our assistant managers and our leasing teams and engineering teams, again, we're vertically integrated. So we need to have certain economies of scale for us to make sense, our particular projects.
Got it. And the footprint for a 200 unit project, how large land or parcel
You
are
know,
we talking about?
again, it's really a function of height and parking. If it's a larger parcel, I can do it, in less stories and have a separate structured garage. If it's a tighter urban site, then I've got to do, kind of a podium configuration. So then, our projects can go 20, 21 stories. And that's, usually If it's it's probably about 250. I mean, 200 is kind of our absolute minimum, but I would say our average project is somewhere between 250 and 350 units.
Got it. So the primary focus, or I mean, I don't say focus, but one of the key indicators is there's just not a an abundance of workforce housing. When I mean, in the neighborhoods, you've identified the components that have to be jobs and need, and that you're wanted, kind of that public private uh, element there. Um, but is excuse me, is the um shoot, I forget where I was going with this. Um, well, I'm going to something, it'll come back here. Um, so we have the various elements. You guys come in and you're the housing. Uh, my question is, as a neighborhood starts to improve and become more desirable, does that not necessarily push the cost for the people to get in based on just the laws of economics and supply and demand? If it's a place where people want to be, all of a sudden the price starts rising. Um, how do you or is that a concern, or how do you guard against that?
Absolutely, and that's really kind of where you have to think about kind of, purpose and profitability not being, mutually exclusive. You need to have a mission, and if you need to solve, if your purpose and your mission is to solve kind of that workforce, we're very intentional in that. So we know that that is kind of our purpose, our mission. So we make sure we do that. In terms of the escalation of rents and so forth, we really think about it. I mean, of course, there's going to be things that are going to escalate rents. What does our payroll look like? What does inflation look like? What does our insurance numbers look like? What do our real estate taxes look like? So those are things that unfortunately do become, sometimes, oftentimes become passed through to our residents in terms of those costs. I think one of the things that Florida has done and has done really well to tackle kind of this workforce housing crisis is what's called our live local ordinance. And it's an ordinance that if you really are, solving for the workforce housing issues, you can get tax abatements. For 3 years at a time, you get real estate tax abatements. And again, you're able to, pass those savings along. So it makes sense for the developer, and it also serves the purpose of trying to solve that workforce, housing crisis that we have right now. I mean, I would say probably, the lack of affordable housing in terms of really the workforce is probably one of the greatest needs, not just in South Florida, where we've had one of the greatest real estate booms and kind of rental increases. But I would say it's a nationwide conversation that we're having right now. How do we tackle this workforce housing shortage? Florida right now has about 76,000 units, in South Florida alone of workforce housing need. So, as fast as we build them, it's as fast as we're getting them, kind of leased and occupied.
Right. No, I think the mission is, admiral, and definitely the need, is there. That's undeniable. And just, I guess the bigger picture is are the residents that come into your units, are their wages able to keep up with the increases of the market? Have you seen anything? I mean, you've been doing this for 20 years. Is there any notes you have that suggest
Yeah.
otherwise, or?
Unfortunately, we do see that attrition that sometimes people do leave South Florida for the affordability, and that's why we're doing what we do. And areas that maybe historically 20 years ago, a recent college grad could live, that's not attainable right now. But if a recent college grad can come to one of our buildings and again and live there and have an exceptional life. And part of the reason they couldn't do it 20 years ago is because there was no housing stock in these neighborhoods. So it's really about kind of, constantly meeting the supply and the demand curves. Although we have, kind of an entrepreneurial spirit to what we do in reimagining neighborhoods, we have an incredible institutional discipline in terms of how we underwrite our projects. So our projects have to make, real sense down to the dollars in terms of, the underwriting and everything we do. It has to make sense at all levels.
Got it. So we've been talking about workforce housing, but one of the things that caught my attention when preparing for this was the focus on communities. I'm curious, is there a number of units? I know that we've talked about 200 is kind of a size of a project, but is there a number that you found that is able to move the needle on a quote community as opposed to just a project? I mean, is there a you know is there a secret number? Do you know if there's a number?
Usually when we get to about 1,000, we start having real impact because now the stakeholders, for example, within City of Miami elections, as large of a city we are, get decided oftentimes by less than 1,000 votes. And that's just the reality of, who comes out, who decides, who are the stakeholders, because we're the workforce, and we're the people that drive the engines. Most of our people are the voting citizens of the community. So when we need to call a commissioner, when we need to call a council person, when we need to have a conversation with the mayor about our community and what our community needs, we've got a real voice and we've got a real seat at the table. And because we own and operate all our buildings, when we're speaking, we're not speaking on behalf of ourselves, but we're speaking on behalf of 1,000 households, minimum of 1,000 households within that community. So when we say that we've got a lighting problem, when we say that the park, really needs some capital improvements, when we say that the sidewalks, really we need to think about these sidewalks. We're not speaking, for ourselves as a developer, or even speaking, as the owner of one building. It's usually multiple buildings. And then, the benefit of that is that the homeowners that are there, the residents that were there before us, are able to reap the benefits. So now they've got these wonderful parks and they've got the wonderful lighting and, they've got the increased safety and security and the anti-graffiti task force and everything else that, we're very cognizant of, and that, we really kind of have this discipline about making sure that, we tackle that from the very beginning. And and after 20 years, I think one of the things that precedes us is our reputation. They know that we've got a commitment to these communities. They know that, we're not going to do a bait and switch. We come in, we're a real partner. We're excited. Oftentimes, our first residents are people that are already in the neighborhoods, that up until that point did not have another option. But, they like the area, they like the neighborhood, they like the convenience of where they are. Just the housing stock wasn't there. And then it's always exciting to also, when we get the anecdotal stories of saying, I grew up in this neighborhood and I moved out and I'm so excited to come back. So
Yeah,
that's always a fun story.
yeah, coming home. So 200 units is a project size, but you feel like 1,000 is when you can really make the quote the community. So when you go into a community, is there multiple projects always a focus in order
Yeah,
to make
yeah,
that a
we
community?
usually, even though we likely, oftentimes announce one, by then we probably acquired some other sites or have interest in other sites, and we've done that. We kind of have a master plan approach to it. So by the time we announce one, oftentimes though, it's just really the first phase of everything that we're doing.
Got it.
So now we're having a lot of fun in this neighborhood called Alapata, which is the last, kind of authentic neighborhood, one of the last authentic neighborhoods in Miami. So we're really having, and it's just had an incredible cultural renaissance. We've got the Rubel Museum, which is, kind of the largest private art collection, modern art collection in the country. They're housed within Alapata. We've got, Super Blue, which is, the digital immersive art. So we've had an incredible cultural renaissance in Alapata. So we're really excited. And what we're particularly excited about is how kind of the origins of the neighborhood, the authenticity of the neighborhood, is kind of going hand in hand with, everything else that's happening.
No, and I think anytime you have new, it's always it's new. It's
Mhm.
got there's an attraction to it because it is new, and if you're able to shape a community, with the projects you're doing, And just there's that kind of a law of attraction that more people they continue to want to be a part of it, whether it be live in it or merchants want to be there because they know there's opportunities, customers that need whatever it is they're selling. So it is neat to be a part of that. I get that, and I applaud you guys for driving that. I'm curious. So you mentioned some of the tax uh, advantages or abatement that's provided in Florida. And then also you mentioned kind of the community receptiveness and that they've got something in motion or they've got some plans that kind of match up with what you're doing to where it all works. And I love that. My curiosity is you mentioned you guys hold the majority or you didn't, maybe I thought you said a percentage, the number of projects that you've done that you are apartments versus the condominiums. What's the split there?
It's about 50-50.
Okay. As far as uh, the rental housing, the apartments, how are you structured as far as your capital stack on that?
Now we structure it very, we're simple in terms of our structuring. We have, our construction loan when we start a project, we have our construction loan, is in place at a, kind of a percentage of the cap stack that we're comfortable with in terms of kind of risk reward. And then the rest of it is, really an equity cap stack somewhere between my LP partner and myself. Our LP partners are oftentimes our repeat LP partners. And so, that's really it's overly simplistic in terms of how we go about it. We like to really mitigate our risk, and we think that this approach is really kind of the way we mitigate our risk with kind of strong equity and a construction loan. Once we obtain our temporary certificate of occupancy, our TCO we usually refinance out with a bridge immediately. As soon as we hit TCO, we stop the clock on that construction loan. We pay off the construction loan. Oftentimes, we're able to take kind of some equity off the table, and then kind of spend the next kind of year and a half stabilizing, really creating our track record, our numbers, having kind of the performance indicators, and then after that, we usually put on some agency debt on it, and kind of by then it's kind of been recapitalized with significant part, if not all of our equity, kind of taken off the project, and then we just kind of stay within the project long term.
Do your investors stay in the project once you
Yes,
refi? Are they
yes.
okay? Okay.
Oftentimes they do, yeah.
Uh,
Yeah. Every project so far, our investors have stayed. That's not to say that we have mechanisms in the event that an investor doesn't want to stay in, and I want to stay. We've got the mechanism, to make sure that we do that. But so far, our partners have, been fantastic, great partners, and continue to believe in what we're doing. So they've stayed on.
so are you actively raising capital or is this you have the
We're always
people?
raising
Okay. Yeah.
I don't know any developer that isn't always
Right.
raising capital. So absolutely.
Got it. Yeah.
Yeah,
No.
we're always, we're always in the market. We're always looking for new relationships. As we, now that we've built a very strong foundation, my background was always, very strong in development, very strong developer. So we have a great development team, and we really were best of class in terms of development and kind of all the technology that we were embracing and affording into our projects in terms of, the design. And through that design build process, we also have in-house general contractors. So that entire process. And then we were third party, our management and our leasing. And, 2-3 years ago, well, like three, maybe even more, 3-4 years ago, we just weren't happy with the status quo. We did not like kind of the third party management. So we built our own business because the same way we were best of class in development, we felt that we were, we needed something that was best of class in terms of the client experience. We were delivering this incredible product. And then the client wasn't able to kind of reap the benefits of this incredible product because we felt that the experience that they were having was not reflective of what we wanted them to have. So we created our own in-house management and leasing company. I would say now we're best of class again, embraced all kinds of technology, everything, from kind of AI through the leasing process, through the management process, to a 24-hour seamless experience for our client. We've really kind of done that. So now that we've built that foundation, whereas our roots, are and will likely always be, within kind of South Florida, we're now looking, kind of at a Florida expansion and then a Southeast expansion. So now that we've built the foundation, we're really kind of ready for that next phase.
Yeah, I love the vision and the, you know, filling that void. I
Mhm.
think while a lot of people I've talked with, there's kind of an ideal of doing that, but I don't know that what I'm hearing from you is the fact that you're able to do scale in a community. I mean, a project of 200 is nice, but if you can get 1,000 units in the community, it feels like that's more of a sense of a quote community, more so than a project of 200 units. And I could see how that could be more, I don't want to say meaningful, but have more of an impact on the community. And
And it is. And again, what we do is, I mean, it's margins, and especially when you're thinking about kind of the workforce. So you have to look at it with, kind of surgical precision, as I call it. We're very precise in terms of, we're not taking a hammer to housing, we're taking a scalpel. And, we're really kind of underwriting every single line, every single expense, every single thing, with this surgical kind of approach to it, and this incredible institutional discipline. And that's how, we're able to get the institutional level returns that's still necessary in the market. Because as mission driven as we are, and the need that we solve, we still have a fiduciary responsibility to our equity partners as well as our lending and banking partners, to make sure that the numbers work and that our business plan does work.
yeah,
So we've been able to do that.
well, and being vertically integrated like you are, with the number of units that are nearby, I mean that makes complete sense and gives you a lot more control. So I applaud you on that. Um, Hey, Lissette, if we could, I'd like to shift gears here for a second.
Sure.
As I mentioned before we started, by day I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is, a risk transfer vehicle. And as such, I like to ask my guest if they can look at their own situation. Could be your investors, could be the public municipalities, could be the interest rates, could be whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Lissette Calderon, what is the biggest risk?
Well, I think in today's world, probably the biggest risk you have is uncertainty. And how do you underwrite uncertainty? What happens next? How do you underwrite, whether it's tariffs, insurance numbers, construction costs? What does that uncertainty look like, and how do you underwrite that? So how do we do it? We really can't avoid it because we're developers. So of course, our job is we really think about how do we minimize it. So we make sure that every project is built oftentimes by the same team, the same architect, the same project, and same contractor and so forth. And then we enter into a guaranteed maximum price contract. So ahead of time, we already know what that number is going to look like. Of course, we build in contingencies, so we minimize those uncertainties. So that's always the hard part. And then in terms of transferring the risk and the insurance, and that's probably how you get to a little bit of the avoiding the risk. Especially in South Florida, one of the things that people always talk about is kind of like sea level rise and flood level, and how does climate play into what we're doing? Well, I can't move our projects out of South Florida because they're in South Florida. The number of our projects. So in terms of transferring the risk, we think about master policies. Our projects are on master policies. So again, we're looking at the risk kind of throughout the entire portfolio, not just on one independent portfolio. And that has been, very effective for us in terms of mitigating our insurance expenses. Because really the two biggest uncontrollables that we have as operators are real estate taxes and insurance. So real estate taxes, we've really been able to address that in Florida through, kind of this statutory, ordinance that's now the Live Local. And, we're really able to address that and work with that. And then from an insurance standpoint, it's always, the next big challenge. And the way insurance numbers, have gone up historically. And we've been able to mitigate that through the master policy. And, and how do we avoid, to the extent possible avoiding, is we build really well. So we've got the flood panels and we build at the right elevations and we put in, kind of the right, glazing and glass and everything that meets or exceeds the South Florida building codes. And then, we try to go into neighborhoods that we know make sense from a, climate standpoint. So Alapata's up on a ridge. And so we really take into account a lot of these things and we think about it. And, it's always very exciting to us, after, a big storm, where you'll see kind of flooding on the streets and some of these pictures that go nationally, our areas, are immediately dry right after the storm. So it's, and I guess that's how we probably avoid it. We build in great locations and we build a great product. How do we minimize it? We get into guaranteed maximum price and really kind of understand what the uncertainty and really try to mitigate that uncertainty. And then in terms of transferring it, we look at master policies and how we put those in place.
Yeah. Risk is everywhere. Looks like you're
Absolutely.
you're dealing with it. So I appreciate that. Lissette, where can the listeners go if they'd like to learn more or connect with you?
Absolutely. Welcome to go to our, obviously follow us on social media, Neology, but Neology on all the social platforms, but always www.neologylife.com. And that will take us, kind of to who we are, our mission, our projects, and then you can, drill down further as to, like the team and everything. If you want to get a hold of us, speak to us, anything along those lines, it definitely, we've got great communication, a great team that's really out there making sure that kind of all our public relations is out there.
Awesome. Well, Lissette Calderon, I cannot say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Absolutely. Thank you.
All right. For
Pleasure
our
having
listeners,
me.
oh, you're welcome. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.